Personal finance, thanks to Forsyth Barr this morning. Experts say it's better to look at how your money is divided up rather than trying to time the market or chase the most fruitful shares. Mark Richardson, investment advisor, Forsyth Barr, friend of the show, is back for Wednesday morning. Mark, good morning.
Yeah, morning, Ryan. That sort of sounds a bit counterproductive, doesn't it? It sounds a bit sort of skew width. I mean, well, you meant to invest in the best companies, but it's not really as simple as that. And there is a really good argument and proof that shows that your asset allocation, which is what we're talking here, is how much you have invested in equities versus how much you've got invested in fixed interest, so bonds and cash, actually in the long term will make all the difference for you, as opposed to going out there and being a stock picker, which is a very, very hard game if you're going to get into that. We're in the middle of reporting season at the moment, and companies are coming out and reporting, and the reaction to that from the analysts and from the market is up, down, round and round, spins on its head. No one quite knows. Sometimes a company reports quite well and we go, that's quite good in the share market, and the share price drops 5-6%. Otherwise, we're looking and go, oh, is that so good? And then all of a sudden it goes up. So rather than focusing all your energy on like picking particular stocks, which is still very important, and you want to be well guided in that regard, it's about how you set up your portfolio as a trade-off between protecting capital in the short term and seeking growth in the long term.
I always think that there's somebody out there much smarter than me that will do it for me, which is always been my approach to this stuff.
Yeah, and you've found them.
Which is why you're here. It's also to do with age and risk appetite, as it always is. We talk about this a lot, but it's true, right?
Yeah.
My risk appetite would be a lot different to somebody of your...
Yeah, if you started with the classic, and people probably heard this, the 60-40. So the 60-40 or the 40-60, classic balanced portfolio. So 60% in equities, 40% in fixed interest and cash. That's balanced. Now, sometimes what should I be? Should I be growth? Should I be more conservative of that? How long do I have to invest? What's my tolerance for risk? Can I deal with sort of volatility in the short term because I'm in this for the long term? There is also a formula that people apply. Okay, well take 110 and subtract your age. So me being around about 50, subtract that off 110, and I end up in that balanced category, 60% equities and 40%. But then I would argue, well, at 50 years old, or 54, I've still got another 10, 15 years of work in front of me. So I could actually be a lot more, I could take on a lot more risk and a lot more volatility because I'm going to go through a few different business cycles. I can sort of handle the ups and downs because I'm still earning a living. So I think that's actually a little bit conservative. And I think in general, I think people should be starting to maybe accept risk a bit more comfortably and think of it more as volatility and go, okay, well, how long have I got? Do I really need to protect my capital? Or have I got time to actually seek a little bit more growth in the long term? Because as people retire as well, you might have 20 years in retirement, and you can draw from your portfolio as a whole. So you can actually, I think a lot of people can stomach a little bit more risk than they might actually think.
Yeah, okay, interesting. Appreciate that. Mark, good to see you as always.
Yep, cheers.
Mark Richardson, investment advisor at Forsyth Barr.